Commission-free trading changed the game. Tap a button, buy a stock, pay nothing. That's the promise, sold in neon and confetti. But here's the paradox. If you aren't paying your broker, who is? And what exactly are they buying when they pay? The answer is a 3-word phrase that sounds boring and hides everything: payment for order flow. HIT asks the invisible fee behind your free trade, the price you pay without a price tag, baked into the plumbing rather than printed on a receipt. This is where money, power, and history collide, and nothing is ever as simple as it looks. Payment for order flow isn't just a line item on a broker's quarterly report. It's an architecture, a set of incentives that moves your orders off the bright stage of public exchanges and into quieter rooms where the real negotiations happen. Follow the chain long enough, and you discover something unsettling. The market pays your broker pays the narrative, and you pay the difference, not in an explicit commission, but in the microscopic drips and drabs of execution quality. Half a cent here, a slightly wider option spread there, the subtle nudge to trade more often or trade more complex products, because the engine hums louder when you do. The fee you don't see is the fee that never stops. To understand how we got here, go back to the first modern shift from human pits to electronic quotes. When markets digitized, a new class of firms rose to power. Wholesalers and market makers, companies that commit to always stand ready to buy from sellers and sell to buyers. They noticed something obvious, but incredibly profitable. Retail orders are different. They're smaller, more predictable, less likely to be toxic in the sense of being informed by massive institutional research or giant hedge fund strategies. In short, they're friendlier to a market maker's bottom line. So a bargain emerged. If a wholesaler could pay a broker for the right to see and execute those retail orders before they hit the public exchange, the wholesaler could earn a tiny, often reliable edge by capturing the spread, the gap between the highest displayed buyer and the lowest displayed seller. From that spread, they could fund everything. The price improvement they show you to prove you got a better trade, the check they'd cut to the broker for routing, and the profit they'd book for themselves. No commission charged, no invoice sent. The economics hum behind the drywall. Once commissions collapsed toward a zero a few years ago, the bargain turned into a business model. Free trades weren't charity. They were a pivot from explicit costs to implicit ones. The market maker pays the broker removes the commission to win your account, and you feed the machine with volume. The miracle of free is financed by fractions of a cent. Millions of fills, microscopic edges, a conveyor belt of pennies. That's the genius. That's the trick. That's the trade. If the metaphor helps imagine a poker table, where the house pays the dealer for the right to seat you at a specific chair, not because they like you, but because your style is predictable and your stakes are small. You press buy, the broker routes your order to a wholesaler, and the wholesaler fills it internally, sometimes at a price a hair better than the best quote on the public exchange. Everyone smiles. You got your improvement. The broker got paid. The wholesaler pocketed the sliver of spread that remained. The public market, where quotes set prices for the world, never even saw your order and never got to compete for it. When that happens, occasionally it's plumbing. When it happens at scale, it starts to shape the river itself. Defenders say that plumbing is progress. If a wholesaler can match or beat the displayed price and deliver an instant fill, retail traders benefit, period. Critics call it a structural conflict of interest, because the broker who owes you best execution also earns more when certain counterparties get your order. The language is careful, the disclosures are long, the dashboards show green check marks and averages that look fine. But incentives speak louder than dashboards. The system only survives if the wholesaler makes more from your order than it pays for your order and your improvement. If the economics didn't tilt that way on average, the checks would stop and the fairy dust would blow away. Here's the part that almost no one tells you. Product matters. Payment for order flow tends to be richer on options than on stocks, because option spreads are wider and more complex. Wider spreads mean more room for the wholesaler to maneuver, more room to share, and more room to profit. And if you've noticed, your app-making options feel like a game, pre-baked strategies, swiping to trade, multi-leg theatrics wrapped in sparkles. That isn't an accident. Your attention is monetizable. Your complexity is monetizable. The more that is monetizable, the better the checks look. No villain necessary. The incentives are enough. The geography matters too. Different referees, different rules. Some markets look at this structural conflict and say, absolutely not, essentially banning the practice for retail customers. Other markets embrace it with guardrails, insisting on price improvement statistics and routing disclosures and best execution reports designed to prove that, on average, retail clients aren't harmed. Those guardrails are important, but they don't change the basic physics. The broker's revenue is tied to where your orders go. Your experience in the app, the speed, the ease, the confetti, exists to generate those orders. And the wholesaler AS goal is to internalize as many of those orders as possible while paying you just enough improvement to keep the machine well-oiled. The cycle is elegant. It is also relentless. If this all sounds abstract, remember the meme stock mania. Retail order flow became the most valuable commodity in finance for a moment. The structure was suddenly visible to everyone. People noticed that routing choices could shape outcomes, that halting buys could tilt the table, that spreads can widen when volatility spikes, that options being free to trade didn't mean they were free to own, because execution quality and implied volatility are their own kind of tax. The public learned an old lesson with a new interface. The rules of the game are written by those who build the table. You are invited. You are welcome. But you are income. Let's slow this down and walk through what actually happens when you press buy. You send a marketable order, which means you're willing to transact now at the best available price. Your broker's routing logic kicks in. It weighs who pays, who fills fast, who shows the right statistics, who negotiated favorable terms. The order travels to a wholesaler that internalizes it, meaning it doesn't go to the exchange as order book. And the wholesaler prints a fill that is nominally equal to or a hair better than what the public quote displayed. From that price, the wholesaler pockets the spread minus your improvement and the rebate to your broker. Your confirmation dings. You feel good. The app is doing its job. But what didn't happen matters too. Your order didn't add visible liquidity to the public market. It didn't help the exchange tighten spreads by competing openly for the best price. It didn't force other resting orders to outbid each other in public. Multiply that by millions of retail trades, and you start to see why critics talk about the fragmentation of price discovery. When a large share of small orders never hits the lit venues grow dimmer. Dimmer venues can mean wider spreads. Wider spreads mean more room for improvement on the internalizer ES side and more profits to divide between wholesalers and brokers. If that sounds circular, that's because it is. The practice that exists to harvest spread can, at scale, help sustain the conditions that keep spreads harvestable. However, there's a nuance that defenders lean on, and they're not wrong. Many small orders executed internally do receive a price better than the displayed quote. If you buy a share at a fractionally better price, that's not fake, it's real. Over a lifetime of small trades, fractions of a cent can add up. The question isn't whether any given trade looks fine on a spreadsheet. The question is where the power in the system resides. Is the competition for your order happening in a public arena where anyone can try to beat the price? Or is the competition happening behind closed doors, where the first right of refusal belongs to firms that have already paid for the privilege? If you believe markets thrive on open competition, this should make you uneasy, even when your personal fill looks good. So what can you do besides shrug? Start with the simplest lever you control. Use more limit orders. A limit order sets the boundary. Fill me here or better. It's not a magic wand, and you can miss fills when the market runs away. But it reduces the chance you pay through the spread just to get speed. It also contributes to visible liquidity if your order is routed to a public exchange, which can help pull spreads tighter over time. Next, treat your broker's routing disclosures like homework. They're dry, they're dense, they're where the truth lives. Learn who buys your broker's flow, how much is internalized, what percentage of marketable orders go off exchange, and how the broker calculates price improvement. If they brag about average improvement, but your slippage looks suspicious on fast-moving names, you'll know why. Mind the product. Options are wonderful tools and unforgiving weapons. They have wider spreads by design, and payment for order flow on options is often richer because there was more room to work with. If your broker's home screen is constantly nudging you toward complex strategies you barely understand, stop and translate the interface. Is this education, or is it the business model showing its hand? Ask yourself the ugliest question. Who benefits most if I press this button? Sometimes the answer is you, but not as often as the splash screen suggests. Compare brokers by the fills they deliver, not the features they dangle. Some firms accept little or no payment for order flow on certain products. Others rely on it heavily. The differences hide in effective spreads and execution quality metrics, not in the color of the trade ticket. And remember that your jurisdiction sets the background. In some places, the practice is banned for retail because regulators view the conflict as irreconcilable. In others, it's allowed with increasingly sharp guardrails designed to push more competition back onto lit venues. Smaller tick sizes, richer disclosure, rules meant to keep the machine honest. Understanding where you stand, legally and literally, is part of understanding what you pay. None of this requires a conspiracy. It requires incentives. Your broker AS incentive is to maximize revenue per order while passing best execution tests and keeping you delighted enough to stay. The wholesaler AS incentive is to internalize flow that is easier to price and hedge than institutional orders, capture as much spread as possible, and outsource some of that spread to you as improvement and to your broker as payment. Your incentive is simple, fast, certain fills at the best possible price, with transparent competition for your order. Sometimes those three incentives line up nicely. Sometimes they don't. When they do, everyone's happy. When they don't, you end up paying in ways the app doesn't itemize. Now pull back and look at the rhetoric. The story you're sold is democratization. The reality is industrialization, industrial scale monetization of retail clicks. Zero commissions open the gates, and that's not nothing. Millions of people who've never touched a brokerage account now own shares and options and ETFs. Access matters. But access is not alignment. The machine that finances your free trades does not exist to make you wealthy. It exists because a large, predictable stream of small orders can be turned into profit by firms that specialize in shaving decimals. If the factory is well regulated and the disclosures are honest, you might come out roughly even or even a little ahead on many trades. If they aren't, the costs hide in the decimals, and the decimals compound. There's a rhythm to this that history knows by heart. Every time markets promise something for nothing, look for the mechanism that makes it possible. Bank accounts pay free interest, but they lend your money overnight. Credit cards give free perks, but they tax the desperate with rates that devour. Streaming platforms give free content, but they auction your attention with precision. In markets, free trading is the same melody in a different key. If the price isn't charged explicitly, it's charged invisibly, through slippage, through spread, through selection bias, through the choices you're nudged to make because those choices make the engine purr. There's also the question of market health. When a large share of retail orders never competes in the open, the public price discovery process loses some oxygen. Less oxygen can mean weaker flames, and weaker flames can mean more room for the internalizers to operate without being forced into tighter quotes by public competition. This is why some reforms try to sharpen tick sizes, modernize the reporting of execution quality, and make it easier to compare apples to apples across brokers and venues. The goal isn't to punish free. It is to ensure that free doesn't quietly hollow out the public square where prices are set for everyone else. You might ask, if the system is so conflicted, why not ban it everywhere and be done? Some places have, and they have their own trade-offs. Higher explicit commissions, more orders forced onto lit venues where speed and certainty may differ, and changes in how brokers fund their platforms. The truth is blunt. There isn't a world where trading costs nothing. The only debate is whether you prefer those costs to be explicit, invisible, or implicit and hidden. The age of zero commission answered that question for many investors, unwittingly, by choosing the hidden route. Once the confetti cannons went off and account openings surged, reversing the psychology got harder. People love free. They forget to ask, free how? So draw your own line with clear eyes. Use limit orders often. Avoid chasing thin names at the market where a single tick will cost you more than any commission would have. Treat options with the respect you'd give a chainsaw. Powerful, precise, and fully capable of cutting the wrong limb. Read the routing and execution reports even if they feel like a dental visit. If you care about your bottom line more than app fireworks, the most boring pages will tell you more than the most exciting ones. And keep this principle nearby. Efficiency and fairness are cousins, not twins. A system can be efficient in how it monetizes retail flow while being unfair in how it allocates the residual costs. If you're a long-term investor mostly placing patient limit orders on large liquid ETFs, you may barely notice the difference. If you're an options-curious day trader hitting marketable orders across volatile names, you are the engine's favorite fuel. The app will make it feel smooth. The costs will live in your fills. The story will always be democratization. The math will always be industrial. The most disarming insight is that payment for order flow is not a glitch to be fixed. It's a policy choice, a market design that swapped explicit commissions for implicit costs. When conditions are calm, you pay less upfront and maybe get decent prices. When volatility spikes, liquidity thins, or complexity rises, the hidden fee can grow teeth. And because the fee is hidden, you tend not to see it clearly until after the account balance does the talking. That's the real risk, not losing money. Everyone loses sometimes, but losing track of where you lost it. Invisible tolls don't trigger outrage. They don't demand attention. They just keep collecting. The pitch for free will not disappear. It's too potent and too popular. What can change is your relationship to it. Learn how the plumbing works. Ask how your orders are routed. Prefer competition over convenience when the trade matters. Don't confuse speed with quality. The difference between a good fill and a glossy fill is measured in basis points. And basis points are where your goals go to die if you ignore them for long enough. The market doesn't need you to be naive to profit from you. It only needs you to be busy. So the next time a screen flashes $0 commission, translate it. Here, price to be determined. The goal isn't to fear the mechanism, it's to understand it. You don't need to rage against the machine to stop feeding it the best parts of your returns. You just need to stop believing that a missing line item means a missing cost. In markets, as in life, the bill always arrives. Sometimes it's printed, sometimes it's embedded. Democracy decides who governs. Markets decide who survives. And markets are built from incentives, not intentions. If your broker is paid by the people who trade against you, no amount of confetti will scrub that conflict into purity. It only makes it prettier. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.